Thinking, fast and slow. The $1 million psychology mistake. Here's a stat that'll make you rethink every financial decision you've ever made. Studies show that 95% of day traders lose money. But here's the kicker. These aren't stupid people. Many have MBA degrees, decades of experience, and access to the same information as Warren Buffett. So why do smart people make dumb money decisions? Daniel Kahneman won a Nobel Prize answering that question, and what he discovered in Thinking Fast and Slow explains why your broke friend drives a BMW while your millionaire neighbor drives a 10-year-old Honda. Today, I'm going to show you the 5 psychological traps that are bleeding your bank account dry and the exact systems millionaires use to outsmart their own brains. Because here's the truth. Building wealth isn't about being smarter. It's about being less stupid with money. And by the end of this video, you'll know exactly which mental shortcuts are sabotaging your financial future. Let's get into it. But first, you need to understand this. Kahneman's entire book boils down to one massive insight. Your brain runs on 2 operating systems. System 1 is fast, automatic, and emotional. It's the voice that screams, "Buy!" when your coworker tells you about a hot stock tip at 3 a.m. System 2 is slow, deliberate, and logical. It's the voice that says, "Wait, let me actually run the numbers on this investment." Here's the problem. System 1 is in the driver's seat 95% of the time. And when it comes to money, System 1 is an idiot. It's the reason you splurge on a $7 latte, but refuse to pay $3 for shipping. It's why you panic, sell stocks during a crash, and FOMO, buy at the peak. System 1 doesn't care about your financial goals. It cares about feeling good right now. And every single day, this mental autopilot is making micro decisions that are costing you thousands, sometimes millions, in potential wealth. So let's break down the 5 ways. System 1 is bankrupting you and how to fight back. Lesson 1. The anchoring trap. You're buying a used car. The dealer says, "This baby was $45,000 new, but for you, $28,000. What's your brain doing right now? It's anchoring. That $45,000 just became your reference point. Suddenly, $28,000 feels like a steal, even if the car's only worth $22,000. Kahneman proved this in hundreds of experiments. Show people a random number before asking them to estimate something, and that random number will skew their answer by 20 to 40%. Your brain latches onto the first number it sees and adjusts from there. And Wall Street knows this. When a stock drops from $100 to $60, your System 1 screams, "It's on sale." But here's what you're missing. Maybe that stock is crashing for a reason. Maybe it's heading to $20. Amateur investors anchor to the 52-week high. They see a stock down 40% and think it's a bargain. Millionaire investors, they ignore the past price completely. They only ask, what is this asset actually worth today? This is why the rich never pay asking price. They don't anchor to what the seller wants. They anchor to what the asset generates. Cash flow, dividends, tangible value. Here's your action step. Open your investment app right now. Find one position where you're down money. Now ask yourself, would I buy this stock today at this price if I didn't already own it? If the answer is no, you're anchored to your purchase price. That's not investing, that's ego protection. Successful investors have a rule. If I wouldn't buy it today, I sell it today. But anchoring is just the beginning. The next trap is even more dangerous because it doesn't feel like a mistake. In fact, it feels like you're being smart. We'll get to that in a minute. Lesson 2. The availability heuristic. Be honest. After the 2022 crypto crash, did you think crypto is dead, even though it had crashed 80% before and always came back? After your friend made $50,000 flipping houses, did you suddenly think real estate was the golden ticket? That's the availability heuristic. Your brain thinks whatever you saw most recently is the most common reality. Kahneman used the example of plane crashes. People see one plane crash on the news and suddenly they're terrified of flying, even though you're 100 times more likely to die driving to the airport. Your System 1 brain makes investment decisions based on the latest viral story, not statistical reality. And the financial media loves this. They know that fear and FOMO drive clicks. Here's a brutal example. In 1999, everyone thought tech stocks were invincible. Then the dot-com crash wiped out $5 trillion. In 2021, everyone thought tech stocks were invincible again. What happened? Another 70% crash in growth stocks. But here's what the data actually shows. Over any 20-year period, the S&P 500 has never had negative returns. Not once in 150 years. But you'd never know that watching CNBC because stocks slowly compound at 10% per year doesn't get clicks. Action step time. Create an availability bias filter. Before making any investment, ask 3 questions. 1. Am I only noticing this because it's trending on Twitter? 2. What was this asset's performance 5 years ago, 10 years ago? 3. If this disappeared from the news tomorrow, would I still want it? Most people bought Zoom stock in 2020 at $500 because it was in every headline. It's now under $70. Meanwhile, boring companies like Costco quietly made millionaires. Now, those first 2 traps will cost you money. But lesson number 3? This is the one that separates the middle class from the millionaires. And 99% of people get it wrong. Lesson 3. Loss aversion and the sunk cost fallacy. Kahneman discovered something wild. Losing $100 hurts about twice as much as gaining $100 feels good. This is called loss aversion, and it's why you'll hold a losing stock for years hoping it comes back, but you'll sell a winning stock after it's up 10% because you're scared of losing your gains. Your brain is literally wired to make you worse at investing. You become risk-averse when you're winning, selling winners too early, and risk-seeking when you're losing, holding losers too long. It's the exact opposite of what builds wealth. Let me show you how expensive this is. Imagine 2 investors. Both start with $10,000. Investor A, the amateur, sells winners at plus 15%, holds losers until break-even. Investor B, the millionaire mindset, cuts losers at minus 8%, lets winners run to plus 50% or more. After 10 years, Investor A has maybe $18,000. Investor B, over $80,000. Same starting capital. The only difference? Investor B fought their loss aversion. Buffett's famous rule is, rule number 1, don't lose money. Rule number 2, don't forget rule number 1. But here's what people miss. He doesn't mean never take a loss. He means never let a small loss become a big loss. Here's where it gets worse. Loss aversion triggers the sunk cost fallacy. You think, I already lost $3,000 on this stock. I can't sell now. I need to make it back. But your $3,000 is gone. The only question that matters is, where should my money be right now to grow the fastest? Your move. Set up stop, loss orders on every single investment. Here's the rule successful traders use. If a stock drops 7 to 8% from your purchase price, you're out. No emotions, no hoping. You admit you were wrong and move on. Think that's too strict? Let's do the math. A stock down 20, 5% needs to go up 30, 3% just to break even. Down 50%, it needs to double. Every percentage point you avoid on the downside is exponential growth you save on the upside. Okay, so you've dodged anchoring, you're filtering out media noise, and you've mastered loss aversion. But there's still 2 more traps. And the next one? It's the reason your neighbor drives a luxury car they can't afford. Lesson 4. The present bias. Quick experiment. Would you rather have $100 today or $110 next week? Most people pick $100 today. Even though waiting 1 week is a 10% return, which annualized is a 520% interest rate. You'd never get that from a bank. This is present bias. Your System 1 brain is obsessed with now. It'll sacrifice massive future gains for tiny instant rewards. Here's how this destroys wealth. Every $1,000 you spend at age 25 is $20,000 plus you won't have at age 65, assuming 8% returns. That $4 daily latte, that's $1,460 per year. Over 40 years with compound growth, that's $380,000. But present bias doesn't just make you spend on coffee. It makes you finance a $60,000 car that drops to $35,000 in 3 years. It makes you rent a luxury apartment instead of house, hacking a duplex. The person who spends $50,000 on lifestyle upgrades in their 20s is the person working until 70. The person who invests that $50,000, they retire at 50. Millionaires use what I call the 10-year rule. Before any major purchase, they ask, will I remember this in 10 years, or will I remember what I could have done with the money? That $1,200 concert ticket? You'll forget it in 10 years. That $1,200 invested? It's $2,400? That $1,000 iPhone upgrade? Obsolete in 3 years. That $1,000 in VTI? It's $4,600 in 20 years. Action step. Automate your wealth. Building today. Set up automatic transfers from checking to investment accounts on payday before you see the money. Pay yourself first. Because if you rely on willpower to invest whatever's left at the end of the month, present bias will win every single time. All right, we're at the final trap, and this one is sneaky because it makes you feel like you're being smart and cautious, but it's actually the reason most people never get rich. Lesson 5. The narrative fallacy. Your brain is a story-making machine. It takes random events and weaves them into neat, logical narratives, even when there's no logic at all. Kahneman calls this the narrative fallacy. You see Tesla stock go up and think, of course, electric vehicles are the future. Then it crashes and you think, of course, Elon's tweets were always a red flag. You create a story after the fact that makes everything seem obvious and predictable. But here's the truth. Markets are largely random in the short term. Most successful investors got lucky, not smart. This is why people lose fortunes following investing gurus. The guru made money on 3 trades. You hear their story, and your brain thinks, this person has figured it out. Then you follow their next 10 trades and lose everything. You see the story of the Uber driver who turned $5,000 into $1 million with GameStop options. What you don't see are the 10,000 people who turned $5,000 into zero trying the same thing. Here's the least sexy truth about building wealth. It's boring. It's systematic. It's buying index funds every month for 30 years regardless of headlines. There's no narrative, no genius insight, no perfect timing, just math, consistency, and compound interest. The millionaires I've studied don't have interesting investing stories. They have boring spreadsheets that go up and to the right for decades. Your final action step: unfollow every FinTalk guru and stock picking newsletter. Delete the investing Discord. Mute the crypto Twitter accounts. Replace them with one boring habit. Every month, invest a fixed percentage of your income into a diversified index fund. That's it. That's the whole strategy. Because here's what the data shows. A simple 60-40 stock bond portfolio rebalanced annually beats 90% of active investors over 20 years. Not because it's smart, because it removes your brain from the equation. Okay, let's bring it home. Here's what we covered. Number 1, the anchoring trap. Stop making decisions based on irrelevant past prices. Number 2, the availability heuristic. The news is designed to make you poor. Number 3, loss aversion. Cut losers fast, let winners run. Number 4, present bias. Automate investing before you see the money. Number 5, the narrative fallacy. Boring systems beat exciting stories. Look, you can't eliminate System 1. It's hardwired. But what you can do is build System 2 safeguards, rules, automation, checklists that protect you from your own psychology. Because the difference between retiring broke and retiring a millionaire isn't IQ. It's not luck. It's not even income. It's simply this. Are you making financial decisions with System 1 emotions or System 2 logic? If you want more financial cheat codes like this, the psychology, the systems, the Monday morning action steps that actually move the needle, smash that subscribe button. I drop a new video every week breaking down the wealth, building principles most people never learn. And here's my question for you. Which of these 5 traps have you fallen into? Was it anchoring to a losing stock? FOMO? Buying from TikTok hype? Drop a comment and let me know. I read every single one, and your story might be the next video. Remember, building wealth isn't about being perfect. It's about being less wrong than everyone else. I'll see you in the next one.
Take control of your future. Like, share, and subscribe to Financial Freedom.